Hello, I'm Adam Harter, Chief Investment Officer, along with Andrew Thrasher, Charter Market Technician and Portfolio Manager. Thank you for joining us on yet another Market Carver. We sure appreciate you joining and giving us some time. We'll give you a couple of thoughts, things that are important in today. And for today, we have two topics. We've got job openings and what the context and what that means, as well as equity seasonality that Andrew will update us on. And so job openings, let's talk about the job market because it's so foundational, so important to the foundation of the economy, not necessarily to the stock market for any given quarter, but it certainly does for fixed income rates and potentially trend changes in the future. So I always want to pay close attention to what's happening in the labor market. Before I talk about openings, just some broader thoughts. This Friday, we will get the biggest of the labor market numbers, biggest in terms of how much attention and how many eyeballs are on that. That is the non-farm payrolls, where the net number of jobs that are created in the economy. So that is obviously a big number. We want to know that, but we also want to take a look at more forward-looking and where the trends of the labor market may go, because number of jobs added, that's always backward-looking, and it doesn't really tell us a whole lot. So we want to pay attention to those things that are more leading. One of them is going to be continuing claims, not on this chart, or initial claims for unemployment insurance. That comes out each week on Friday. And that's important because there's really no fudging to that data. If you are unemployed and you need unemployment insurance, you will file those claims. So those are widely watched, and for good reason. When those begin to spike, it becomes a difficult process to reverse once it trends in one direction or the other. Most of the time, it is spent mostly just flat in kind of a steady state. So we're looking for trend changes. Again, that's not on this chart, but I'm going to set that up and get to it. Another one in the middle ground is it comes out with a monthly JOLTS report. It's the job opening and labor turnover statistics. And one of the key factors of that are job openings. So in terms of health of the market, for going forward for the labor market, it's important to know how many listings are out there, how many companies are wanting to hire, and in how many positions. Because that gives you what the capacity is to hire going forward. And so there's two lines on this chart. The blue one is the Federal Reserve fund rate. We won't talk about as much on this chart. It's just overlaid from this piece. And then the red one is an important statistic. That is telling us how many openings there are in the economy relative to how many there are unemployed. It gives you one ratio, one factor that can tell you whether it's a employer-friendly job market or an employee friendly job market. And right now we are right smack in middle ground. If we go back just as we were coming out of the COVID cycle, we had a unique scenario where companies were just trying to hire as many employees that they could. In fact, we got to a point in time where there were 2 jobs available for everyone unemployed. And so employees really had the upper hand here. We have been working that down. And again, that is neither a good thing nor a bad thing. Mostly, it has been a sign of a strong labor market as those openings that were put forth by the companies were indeed filled over time in its backlog. So as this continues to work itself down, though, we are at a critical juncture. It gets tighter from here for positions to be filled and to continue to have healthy numbers at our labor market force. So when this initial chart was published here, we were just under that 1.0. Some good news here in real time, just before we launch onto the Market Carver. This month's job openings just hit and they bounced in the correct direction. So even though we have had a lot of negative noise through the year, that is one positive indication that the labor market's just not weakening that much. So that's really where we're at here. Of course, the non-farm payroll will get the most attention. But we want to see the see-through here on where things are going. So that's a labor market. I know, Andrew, everybody's got a keen eye to seasonality, and I always find this time of the season confusing or off-putting for a lot of people. And I want you to add some clarity to how they should be thinking about June.
All right, I appreciate it, Adam. So as we close the calendar on May, we're going into June, and we always want to check in on the seasonal patterns of the market. If you watched the Market Carver for a long period of time, you probably remember last year we spent a lot of time talking about the presidential cycle, looking at how the market moves at different stages of the election time period. And the market was followed that pattern pretty closely. Now, as we turn to just looking from month to month, we can see that in the summertime is when we start to see a little bit more gyration, a little bit more volatility in equities. And when we look at June, we can see the beginnings of that. On this chart on the top panel, we can see at the start of June on that blue line on the top, that it has a pretty good start. We start seeing the market move higher, things are looking good, and then towards the end is when we start seeing a little bit of rough spots. Now, the big caveat to that is just because June seasonality sees some downturns or the market begin to move lower towards the end of the month, it doesn't mean it's required to follow that pattern. It's also like to point out that doesn't necessarily mean that it turns outright negative. It just historically starts to give back some of the gains from earlier in the month. And why this is important to know is as we watch the market in June, we want to see, is it following its historical pattern? Do we see early month strength? Do we see late month weakness? Is it following these patterns and gives us an idea if the market really is in tune with its seasonality? Now, on the bottom panel gives us a little bit of a step back zooming out, and we can see that June is about the fourth weakest month of the year. You can see in the blue panel there that it doesn't necessarily mean that June's an outright negative month. Historically, actually, September has been an average of a negative month, but it just has produced less gains than some other months. And so this can put the picture for where we see price move this month in better focus as we understand as those kind of gyrations come, that that's actually pretty normal for the month of June. Just like for people that are out water skiing, they know that the temperature is 90 degrees. That's a pretty normal temperature for late June or July as we start seeing temperatures rise here in Indiana. So it's good to understand what these historical patterns are, again, but it doesn't mean the market's required to follow them. But we always want to incorporate as much data and more insight as we can into our process and how we evaluate risk and take different opportunities into your portfolios.
Awesome. Thank you, Andrew. Always appreciate that update. And it's just not as easy as sell in May and go away as a lot of newsletters. Right. There's a lot more granular to that detail. So thank you to all of you for your time. As always, if we can be of help, please don't hesitate to give us a call. That's 800-928-4001 or scan the QR code and book so electronically. Thanks and have a great weekend.